Summing up the outlook for 2020, Schroders CIO thinks that superficially, overall market valuations look uninteresting. But dig a little deeper and there may be reasons for active investors to be enthusiastic about 2020. As we move into a new decade, we don't think it's time to party like it's 1999, but it's not a time for pessimism either. Certainly, all is still not rosy economically and we are seeing anaemic measures of industrial activity. However, the absence of inflation has allowed central banks to be much more proactive than they would normally be, and we are seeing signs of stabilisation in the money supply. Against an uncertain economic backdrop, investors sought out companies that offer steady and reliable growth. For the year ahead, areas more sensitive to the economic cycle may return to favour as long as we see the economic data stabilising. The challenge on this front is twofold. Firstly, U.S. fiscal stimulus is waning, and secondly, trade tensions between the U.S. and China remain a key risk. As a consequence, markets are likely to remain very dependent on liquidity. They have become reliant on the effects of quantitative easing, the much-heralded policy that has seen central banks buy vast amounts of government bonds or other financial assets to inject liquidity into the economy. One of its effects has been to keep bond yields suppressed and thus underpinned higher valuations of equities, shares. Despite the unwinding of I believe the path of least resistance is for shares to move gradually higher. Beginning with bonds in 2019, the fall in bond yields improved the valuations of most other asset classes, so it is important to start with expectations for developed government bond yields. On this front, my view is that any rise in bond yields, and thus any fall in prices, is likely to be contained by the absence of an emphatic economic recovery, low inflation and the institutional demand for yield as pension funds seek to de-risk. This means they are reducing exposure to riskier assets such as equities in favor of more stable assets such as bonds that provide a yield. This provides some support for equity valuations, although from here it is hard to see a further re-rating, whereby investors get more excited about equities and are willing to pay a higher price for them. Low rates also lead to an unrelenting search for yield in corporate bond, credit, markets, which we expect to continue. But we would advocate a more selective approach within credit markets. Mixed picture for earnings and equities, which brings us onto corporate earnings, profits, where we think estimates for 2020 look high, particularly in the US. This is because the US is in the later stages of its economic cycle. The economic cycle is how an economy fluctuates between periods of expansion, growth, and contraction, recession. At this late stage of the cycle, for more on this story, visit the news article link.